I'm Larry Kotlikoff. I'm president of Economic Security Planning. I want to show you a new feature of our software that will help you think about how to invest your money and how aggressively to spend your money through time. Or if you're planning for a client, it will help you give advice with respect to the client's investment portfolio and also spending behavior. So I'll take you through a case that I've set up. It's a couple. The couple's age 54, both the husband and the wife. One of the spouses earns $200,000 and the other spouse earns $50,000. They both have Social Security earnings histories, which are entered here into the program. And they have retirement accounts. One spouse has a $750,000 retirement account. The other has $250,000, so $1 million in total. The household also has regular assets, non-retirement account assets of $400,000. They have a house that's worth $1 million with a $300,000 mortgage, and they have two children, age 14 and age 16. I'm going to click here now on reports, and I'll go to the Monte Carlo risk analysis and run that report. The first thing you're going to see here is that I've set up three different strategies for us to take a look at. A strategy is a combination of two things. It's how the couple is going to invest their money through time. It's also how aggressively they're going to be spending. So this screen is talking about their investments, and I've set up the base strategy to have them invest 50-50 stocks and bonds through the rest of their life. I could have set up a much more complicated time-varying strategy where the share of bonds was changing through time. I could have introduced specific assets, General Motors stock, for example. So there's lots of options in the software for setting up investment strategies. The safe strategy has a different combination of stocks and bonds. It's 20% bonds and 80% stock. The risky strategy involves 80% stock holdings and 20% bonds. So again, the base strategy, all the assets, retirement accounts and regular assets, it's 50-50 bonds and stock. The safe strategy is 20% bonds, 80% stock, again, with respect to all the different assets they're holding. And the risky strategy goes the other way. It's 80% stock, 20% bonds. And I've just chosen these to keep things as simple as possible to show you the comparison. Now, the next screen is about the couple's spending strategy. Here I've kept the spending strategy to be the same for all three cases. And the spending strategy involves setting a as-if rate of return. So here we have on the screen a 3.5% nominal rate of return. You can see it here and here. Everywhere on the screen it says 3.5% nominal safe rate of return. The inflation rate underlying the case is 2.5%. So the assumption is that the couple is going to spend through time as if it will receive a 1% real rate of return. That's 1% above inflation. 3.5% nominal, 2.5% inflation. The difference is about 1% real rate of return. And so the way the program works is that, and I'll tell you this as the program is doing its calculations, the way the spending works is the couple at age 54 decides to spend as if it's going to always earn a 1% real rate of return, a 1% return after inflation. And that determines what it's going to spend this year at age 54. And then the software is choosing to draw returns from the distribution of bonds and stocks. So it's drawing at random what returns they're going to receive this year at age 54. And then with that information and the other information about how much they're going to be spending this year and their labor income and taking into account their taxes and other cash flow information, we can move the couple from age 54 to age 55. At age 55, we redo the analysis. We ask what will they spend now that they're in this position at age 55, having received the rates of return they did receive. How much will they spend? Again, assuming they're going to always earn a 1% real return. So we proceed through their entire life this way, and this generates a trajectory of their living standard. It's a path of their spending, their discretionary spending, with an adjustment for the number of people in the household and economies of shared living and the relative cost of kids. So this is really the living standard per person measured in dollars in the household. And you can see that in this trajectory, and it's one of 500 that we're running for the base strategy, but we also run 500 trajectories for the safe strategy and for the risky strategy. And I'll be comparing those results with you in a few minutes. But for the base strategy here, we have a trajectory, a typical trajectory. This one involves a lot of high returns, but you can see that not every year the returns were that high, because the living standard goes up in some years and down in other years. So there's lots of zigs and zags in the living standard, because even if you do well on average, and this is a trajectory chosen to show good results on average, it's one of the 500 that we ran, you're not going to do well in terms of your returns every year. So what about another trajectory? And here's one that we pulled out that doesn't do quite as well. And you can see that it's got a lower path of living standard. And again, there's some ups and downs. But there's 500 of these trajectories that we're producing to give you a feeling for where you will end up if you invest in stocks and bonds in a 50-50 ratio, 50% stock, 50% bonds. And here's another picture which shows you the percentile trajectories. This red trajectory at the bottom is the lowest 5% percentile. So that means it's, of the 500 trajectories, it has the fifth lowest average living standard. The green curve here at the top is the 95th percentile. So of the 500 trajectories that we generated, this one is the fifth from the top. It's the 95th highest average living standard trajectory. It's a trajectory with a 95th highest average living standard. So you get to see the level and spread of your living standard through time. And these trajectories are basically heading north, because the couple here is spending very cautiously. They're spending as if they're going to earn a 1% safe return. But this is not the ultimate downside, because there are trajectories that have even lower living standards. We're just showing the fifth percentile here, not the first percentile. So that's one of the figures that we generate. We have some other descriptions of these trajectories, which I'll let you look at when you run the program. Here's another picture that encapsulates all the trajectories in one summary type of chart that pools information across different years. But I now want to compare these different strategies that we have set up, the different investment strategies. And when I clicked, we came to this screen, and this screen invites you to, first of all, consider how tolerant you are of risk. So if you're very risk averse, you're not very tolerant of risk, you can't tolerate much risk, you're going to be over here or over here, where the answer to this question, how much risk can you tolerate, is almost none or very little. Well, let's suppose that you specify almost none. Well, in that case, this chart is saying that you're going to prefer the safe strategy to the base strategy. And the base strategy is the base strategy value here you can see is set at 100, and the safe strategy there is 102. Now, what are we actually showing here? Well, what we're showing here is the lifetime utility on average that you'll get from the base strategy versus the safe strategy. Base strategy again is 100, and safe strategy is 102, and the risky strategy does worse, it's 90. So what is the lifetime utility? Well, it's a measure that economists use. It's the standard measure of happiness, and it takes into account how risk averse somebody is. So when we say this person is, the couple's very, in this case, very risk averse, that's a parameter or coefficient that enters into this measure of lifetime happiness. And we are evaluating the lifetime happiness under each trajectory. There's 500 of them. We take the average value. That gives us the average, or in statistical terms, that's called the expected lifetime utility. So what we're showing here is that on average, utility is higher with the safe strategy because the couple is quite risk averse. But if they're not risk averse, well, actually, if they can tolerate a lot of risk, they're way over here in terms of the column that they want to look at. And you can see in this case that the risky strategy surpasses the base strategy. It's 7% higher, and the safe strategy is about 13% lower. Now, what does this mean exactly? What does a 7% higher mean? Well, it means that this strategy of holding 80% stock and 20% bonds is producing, on average, a lifetime utility that's 7% higher in the following sense. It's delivering a lifetime utility, an average lifetime utility, an expected lifetime utility that is equal to what you get in the base case, what the couple will get in the base case, the base strategy, if they took that strategy, but also were to be able to consume 7% more in all circumstances. So this 7% higher value, you can see this is 107 versus 100. It's based on what we call a consumption equivalent. It's like being stuck with a base strategy but getting to consume 7% more. So this strategy will deliver lifetime utility for this degree of risk aversion that's equivalent to using the base case strategy, 50-50 stocks and bonds rather than 80-20, but being able to somehow consume 7% more. And that's the sense in which the risky strategy is 7% higher in terms of its expected lifetime utility. So this chart is a way to get some guidance on what investment strategy may be best for you. It depends, again, on your degree of risk aversion, so you have to figure out how risk averse you might be and look in that column. And you really can't compare columns here because you're either this risk averse or that risk averse or this risk averse, but you're not one or the other. I mean, you're not both. You're just one of these 5 values. And so the program's giving you some guidance here. We have some other comparison charts further down on this screen that you can take a look at, comparing the different trajectories, the set of trajectories, the 500 trajectories for the base case and for the base strategy, and the 500 for the safe strategy, and the 500 for the risky. We're comparing all 3. So we're giving you some guidance in 2 different ways. One is kind of a summary valuation in terms of the lifetime expected utility. Another is by just showing you how these trajectory plots look, how the set of trajectories compare one with another. And I want to leave you with this important point, which is that our software isn't really recommending any particular investment for you. It's not designed to do that. It's designed to provide education, guidance, but it's not uh, here to say, well, you should hold this particular portfolio because uh, we're not sure whether you have a utility function, a mathematical form for your happiness function, which corresponds to the standard one that economists use. And uh, so we're not in a position to say this is exactly what you should be holding. But I think we are giving you some guidance here, but also with the charts below into thinking about what you want to do, how much risk you want to take on, how you want to allocate your assets through time. And again, you have lots of options to consider lots of different investments, different assets that you might hold, and different shares of those assets in your portfolio of assets through time that can be changing through time. So I hope this uh, video has been instructive for this new feature, and I hope you'll take a careful look at your portfolio with this lens that we were providing. And I want to thank you so much for being our customer and supporting our company. And thank you again. Bye bye.